All right, let's jump right in. So, you're doing the right thing. You're working hard, you're saving for retirement. That's awesome. But there's this one little thing, a huge thing actually, that can totally change the game: taxes. Seriously, the choice you make right now about which account you use could literally mean tens of thousands of dollars more or less in your pocket when you finally kick back and retire. And that's really the heart of the matter, isn't it? It all boils down to this one simple question: a traditional IRA versus a Roth IRA. Which one is actually going to leave you with more cold, hard cash to spend in retirement? Seems like a straightforward question, but you'll see the answer is, well, it's pretty strategic. So let's call this the retirement tax puzzle, because that's really what it is. You're not just picking an account. You're playing a long game, trying to set up all the pieces just right to shield your money from taxes down the road. And believe me, getting this puzzle right, that means keeping way more of what you earned. You know, this quote here really nails it. It's not just about how big a pile of money you can build. As Robert Wesley, a CPA, puts it, your whole mindset has to shift in retirement. It becomes all about how you draw down that money, how you take it out. And getting that part right, whoa, it makes a huge difference. We're talking make or break for your financial future. Okay, so how do we actually solve this thing? Well, it turns out this whole complicated sounding debate, this whole showdown between traditional and Roth, it all hinges on one single super important question about timing. That's it. It boils down to this: when do you want to pay your taxes? Now or later? And here it is, the fundamental trade-off laid out plain and simple. Think of the traditional IRA as your tax break today option. You put money in and you might get a nice little deduction on your taxes right now. Awesome, right? But the Roth IRA is the tax-free tomorrow plan. You pay your taxes up front so that later, when you're retired, every single dollar you take out is completely 100% tax-free. A pretty sweet deal. So let's just make sure we're all on the same page. The traditional IRA, this is the classic pay me later plan. You contribute money and you might get to deduct it from your income, which lowers your tax bill today. But, and this is a big but, the tax man always comes calling. Every single penny you withdraw in retirement gets taxed as regular income. Now, the Roth IRA, it completely flips that on its head. This is your pay me now account. You don't get a tax break for putting money in because, well, you're using after-tax dollars. But oh man, the reward for that it's huge. Once you hit retirement age and meet a couple of simple rules, those withdrawals are 100% tax-free. And I don't just mean what you put in, I mean all the growth too, every bit of it. All right, so we've got the basic idea down, right? Pay now or pay later. Now for the fun part. Let's throw these two accounts into the ring, head to head, and really break down the differences. This is where you'll see the little details that can make a massive difference in your strategy. Okay, let's just run down this chart real quick. The first two lines, that's the tax deduction and withdrawal tax. We've talked about that. But check out this third one, RMDs. That stands for Required Minimum Distributions. With a traditional IRA, at a certain age, the government basically forces you to start taking money out so they can finally tax it. But with a Roth, nope. The original owner never has to take a dime out if they don't want to. That's huge for flexibility. And then there's the last point, income limits. Yeah, turns out not everyone is even allowed to play the Roth game, which is a big deal. So yeah, about those income limits, this is a really important catch. If you're a high-income earner, the government might actually prevent you from contributing directly to a Roth IRA. They have these phase-out ranges, and if your income is above a certain level, sorry, the door is closed for you. It's a key difference because with a traditional IRA, pretty much anyone with a job can contribute, no matter how much they make. What about getting your money out early? This is a big one. For both accounts, if you try to take money out before you're 59 and a half, you're usually going to get hit with a 10% penalty. Ouch. But the Roth IRA has this amazing superpower. You can take out the money you personally contributed. We're not talking about the investment earnings, just your own cash, anytime you want, for any reason. No tax, no penalty. That is a level of flexibility that the traditional IRA just can't touch. All right, so we've got all the pieces of our puzzle on the table now. We understand the tax timing, we know about those RMDs, and we've seen the unique withdrawal rules. We have all the info. So, are you ready to finally solve this thing? Let's figure out which account actually makes you more money. And it all comes down to this. Seriously, if you remember one thing from this whole explainer, make it this question. Your entire choice, the whole strategy, it all hangs on your best guess for this one thing. Will your income tax rate be higher or lower?
in retirement compared to where it is right now.
So here's the game plan, nice and simple. Think your tax rate will be lower when you retire? Maybe you're at the peak of your career right now. If that's you, then a traditional IRA makes a ton of sense. You get the tax deduction today while your tax rate is high. But what if you think your tax rate will be higher in retirement? Maybe you're young, your career is just taking off. Then the Roth is absolutely the way to go. You pay the taxes now at your current lower rate, and then you get to laugh all the way to the bank with tax-free money when your rate is much higher.
Let's make this real with a quick example. Imagine you have 100 grand in each account when you retire. With a traditional IRA, you haven't paid tax on that yet, right? So if your tax rate in retirement is, let's say, 15%, you'd owe $15,000. You get to keep 85 grand. Not bad. But with the Roth, you already paid your taxes. That $100,000 is $100,000. It's all yours. So you can see the Roth literally puts more money in your hand. So as we bring this all together, I hope you see this isn't just some boring accounting choice. It's way more personal than that. You're basically making a bet on yourself. You're taking a look at your life, your career, and deciding what you think your financial future is going to look like. So what's the bottom line? The secret to having more money to spend in retirement, it all comes down to making a really smart guess about your future tax situation. It's a strategic bet. You're betting on whether your tax bracket is going to be higher or lower decades from now. That's the whole game.
And I'll leave you with this final thought to chew on. You can probably make a decent guess about your own career path, right? You know if you're on the upswing, but there's a huge wild card in this whole equation. What will the country's tax rates be in 20 or 30 years? You can forecast your own life, but can you forecast that? That's the billion-dollar question, isn't it?